Good morning from Prague here at CTP's headquarters. Thank you for joining and for dialing in with some good news. So far, Q1 has been a bit bumpy and a bit interesting, I would say, for CTP, for our clients. The markets have seen a lot of change and opportunity, which we like at CTP. We are an entrepreneurial property company, very dynamic and ready to make quick decisions with money in hand, so that the market where we are currently definitely is an interesting market and circumstances which we will do our very best to benefit from. Um, it's about, I think, deglobalization. It's about nearshoring. It's about bringing production to the markets where your clients are. With 450 million consumers in Europe, we see a lot of companies coming to Europe to set up business, to grow their business. That's what we have been doing for the past more than 2 decades, to help companies set up business and grow their business in Central Europe for the European market. Nowadays, we see Asian companies coming in. I've just returned back from another trip to Asia to visit our clients who are bringing more business to Europe for European market, as explained. Multiple reasons. Decarbonization, tariffs is an issue, geopolitical circumstances. So there are lots of reasons why to bring production or e-commerce activities to Europe for European markets going forward. Different industries, automotive still very interesting, e-commerce, obviously technology, the electronics sector, AI driven maybe push, but also data center, and not necessarily us building data centers, but many of our clients somehow involved in the data center industry, especially Taiwanese, when I refer to the Asian clients. So a lot of change going on, and definitely interesting for us to be part of. With regards to business, so far Q1 has been good. Back to the Asian is around 20% of our new business. We still do a lot of business with existing clients, as you know. That is still the largest driver at CTP. So business we do for existing clients who came over, who started to work with CTP and then continue to grow. Maybe also because we offer small, medium-sized properties to help them get started. And then when they need more, we can offer them a larger building, sometimes within the same park. We can do an extension. Or also we see that we do for existing clients property solutions in different parts of the portfolio, which we are currently in 10 markets, and looking at other markets to open up as well. We did sign 416,000 square meters of leases during Q1 of 25, and 416 is almost 25% up compared to last year. And so we've done more leases, we signed more leases, and I think more importantly, also we continue to collect more euros per square meter per month. So we continue to see rental growth around 3% more than we got for the same square meter a year ago. Before I mentioned nearshoring, one of the drivers. We'll also see large fashion retailers who continue to grow footprint. I mentioned fashion retailers the other day, but there's also pet food. Europeans, they love pets. They have rabbits and donkeys, and pet food is just a great industry to be part of. We do that as well. And also pharmaceutical. We have seen many of our clients grow their business. That's all, of course, also to do with the consumer spending, which is just growing in Central European countries because people make more money. So that's what we do as well. Defense industry, we see consumer electronics, we see, yes, it's very diverse, actually. We have so many different clients, multinationals or SMEs in different businesses. So not overexposed to one industry or one specific client, but rather diversify. Tenants are happy, and that's very important. We are almost 1,000 people here at CTP, and I always say keep your clients happy, make sure that they can do their business, and if they do their business, if they're successful, they will come to you for more space, or maybe they will talk to you with their suppliers, with their friends, and then through them you can get more business, and that is number one. So talk to your clients and make sure clients are happy, buildings are in an excellent condition, and that's the target. Retention rate 90%, 90. So the park model continues to be successful, growing with existing tenants, offering new tenants attractive locations. With obviously the concept and the model of having these CT park projects with CTP people on site in the parks, look after the buildings, look after the tenants, close to where the action is, stay connected to the core business. Especially nowadays when we see CDP growing, it's very important to stay and stick to the core business and create micro teams so they can actually focus on the business going forward. Yeah, maybe break it down, operator. Our business is responsible for the income producing part. Stable occupancy, around 93%. WALT, 6.5 years. And together is a 13.4 million square meter of lettable area. And that is good for 750 million euro of rental income. With more than 1,500 different clients and tenants from all kind of different industry in those buildings. That's for the operator. Jump to the developer, in-house construction company. I'm very passionate about building new buildings, and we continue to prepare a lot of projects and do a lot of innovations, making buildings better, new buildings, but also the existing buildings. Continue to invest, make sure that these are in excellent condition. We see lots of opportunities to do better, also to create parks with more amenities and services, and of course utilities on site. At 10% yield on cost, as we've been doing. Big thank you to the team of in-house design, procurement, all of the people involved in the construction management to build good quality properties to last, genetic designed. Q1 in terms of deliveries has been quite small, below 100,000 square meter, but we still have a 1.9 million square meter under construction. For most of that, I think we can complete this year. Almost 80% of the 1.9 million square meter under construction is within existing business parks. So when we started with a park, we bought land, we do a nice master plan, we start to build infrastructure, and one after the other building is being built, and then we have more land to go with zoning, with permits, with infrastructure and utilities to build on those land plots for the same company or for other companies, and to continue build larger business parks. And that's 80% of all what we have under construction. Benefit is that we know the location, know the authorities, we have infrastructure. So limited risk, we can start a development and then see how we can lease it up and then complete the building on time. When this 1.9 million square meter is completed, we think it will produce another 148 million euro of rental income. We think we do that north of 10% yield on cost. And we think that by end of this year, Q1 into next year, most of that will be leased and will become part of the portfolio, and then will be transferred to the operator. Poland, good demand, largest country, can be very competitive. We got hold of a few very nice sites there where we can do nice projects for good clients. Yeah, so overall quite satisfied with what we see in Poland, the engine of Central Europe. If Central Europe is the engine of Europe, then within Central Europe, Poland, definitely a large opportunity. We are moving on in Germany. As you remember, we bought some land sites. So two things in Germany. One is the Deutsche Industrie. That's the portfolio of properties we bought, 100 buildings. We are working on the clients, make sure buildings are in a good condition. We need to invest here and there, but in return, we get rental growth. At the same time, the future of CTP Germany is much more to develop. And we have been very lucky, I think, that we have got hold of a couple of land sites, Düsseldorf, Mülheim, also Stuttgart, Rastatt, etc., Krefeld, where we are currently either under construction or preparing for construction next year. And we are quite advanced at the same time doing the leasing. So it's a mix of SMEs, so small business units, let's say 450, 500, maybe 1,000 square meters, 800 square meters, well below 1,000 with a loading dock in a good location in the city center, close to the city center. In most of the locations, Rastatt, Krefeld, those locations I refer to. But then also you have larger sites, Mülheim, Düsseldorf. Mülheim will start construction next year. I think Düsseldorf is going to take a bit longer, but we have the full support of the city of Düsseldorf as well. So Yeah, a lot of opportunity. I continue to visit Germany every week. The management team has grown a lot, and in terms of responsibility, in terms of where we want to go with CTP Germany for the coming years, and we have a nice business plan for 2030. So that looks good. So overall, quite positive and maybe a bit better than you would expect. Seems to be good, a good demand, and in Europe for Europe, and then definitely CTP with our activities in Central Europe, with the strong client base we have, with all of the local knowledge. I think we are in a good position. So thank you very much for your attention. I will be available for any questions if you have later on. I will now hand over to Maarten. Thank you.
Moving on to the financial highlights. The like-for-like rental growth came to 4.2% in Q1 25, driven by indexation and strong rent reversion. Occupancy remained stable at 93%. And our gross rental income increased by 15.9% year-on-year to 182.5 million euros. Net rental income went up by 16.8% year-on-year as we reduced the service charge leakage further. Consequently, the NOI to GRI ratio came to 98.3%. Annualized rental income increased to 748 million euros, illustrating the strong cash flow generation of our portfolio. And we confirm our target to reach an annualized rental income of 1 billion euros by 2027. The company's specific adjusted EPRA earnings per share increased 6.9% year-on-year to 21 euro cents, on track to reach our guidance for 25. As highlighted with the 24 results, we did a material amount of refinancing in 24, so we repriced the vast majority of our debt stack. This results in a slight headwind for the 25 EPS, but we expect to return to double-digit EPS growth from 26 onwards. Now, looking at the valuation results. For the Q1 and Q3 results, only the investment properties under development are revalued. In Q1 25, the revaluation amounted to 156.2 million euros, driven by the construction and leasing progress on our developments. Our total gross assets value now stands at 16.3 billion euros, up 2.3% in Q1 25 and 16.7% year-on-year. CTP's reversionary yield stands at conservative 7.1%. We saw the first yield compression in the second half of last year, and we expect both further yield compression in 25 as well as positive ERV growth for the CEE region. In most CEE markets, inflation-adjusted real rents remain lower than 15 years ago, illustrating the affordability of the region for our tenants as well as the mid-term rental growth potential. This is also illustrated by the new leases that we signed in Q1 25, which were 3% higher than the new leases signed in Q1 24. We also saw transaction markets reopening across Europe, as there is more clarity around funding cost. And especially on the private equity side, its funds coming to their maturity, we expect to see more churn. This will further support our valuations, but as well offer opportunities for us. Our EPRA net tangible assets per share increased from 18 euros and 8 cents at year-end 24 to 18 euros and 58 cents at quarter end, representing an increase of 2.8%. Year-on-year, the increase was 12.6%. With this NTA growth and our dividend, we delivered a total accounting return of 16% in the last 12 months to our shareholders. And now I hand over to Richard.
In Q1 2025, we raised 1.2 billion euros of debt to further improve our liquidity position. We issued 1 billion euro of bonds directly after our full year 2024 results, seizing the market opportunity ahead of the tariff announcements and the subsequent market turmoil. In addition, we closed our inaugural Samurai loan of 30 billion yen, the equivalent of 185 million euros. Diversifying the sources of our funding is one of our main priorities. We transformed CTP from a purely euro senior secured financing structure in 2020 to now having a largely unsecured financing structure, and we did this through bonds, private placements, unsecured syndicated bank loans, consistent with our stable investment grade rating. Adding the Japanese yen market to our funding mix further improves our position, as the Japanese yen market, which is the world's third largest lending market after US dollars and euros, is competitive at different times than the euro market. We continue to actively manage the loan portfolio in Q1 2025 and negotiated margin reductions on a further 159 million euros of secured bank loans. In total, we have renegotiated or repaid over 1.1 billion euros of our most expensive bank loans in recent months. Our cash position stands at 1.8 billion euros. When including our RCF, our liquidity position amounts to 3.1 billion euros, more than sufficient to meet our cash needs for the next 12 months. The average maturity of our debt stands at 5.1 years, with only 547 million euros of debt maturities in 2025. At the end of the quarter, CTP's average cost of debt came to 2.9%, slightly down compared to year-end 2024, as the renegotiated secured loans with lower margins reduced our funding costs from Q1. Our marginal cost of funding is currently around 4% for 5-year money. Thanks to our strong cash-generating portfolio, we have a healthy interest coverage ratio of 2.5 times, while our normalized net debt to EBITDA remains stable at 9.1 times. As shown during our last Capital Markets Day, thanks to our market-leading development yield on cost of over 10%, each euro we invest in our pipeline increases our ICR and decreases our net debt to EBITDA. Our loan-to-value stands at 45.3%, stable from year-end 2024. We are confident in the outlook for CTP. Our leasing remains strong. We see nearshoring speeding up in many industries, with production in Europe for Europe continuing to drive demand. Our pipeline is highly profitable, and our growth is tenant-led. Thanks to our industry-leading yield on cost of over 10%, we're able to deliver sustainable and profitable organic growth while maintaining our strong financial position. We confirm our EPS guidance of 86 to 88 cents for 2025, representing an 8 to 10% growth compared to 2024, and we expect to deliver 1.2 to 1.7 million square meters of developments this year, in line with our long-term growth targets. Thank you for your attention. We now welcome your questions.
Our first question comes from Marios Pastou from Bernstein. Your line is open. Please go ahead.
Good morning. Thank you for taking my questions. Just two from my side. So firstly, very positive leasing in the first quarter. Can you comment on how this has trended over the second quarter so far? Are you seeing any change in momentum or any occupiers delaying their decision-making in light of uncertainties? And then secondly, maybe if we move to Romania, are you seeing any changes in occupier intentions considering the ongoing headlines over elections? Thank you.
Hi, Marios. Good morning. I think Remo will comment on the leasing question, but let me take the first question on Romania. Ultimately, what you see is that political volatility is everywhere in Europe. We see that across different markets. Many times it's more headlines in the news than it impacts our business. We have, for example, seen in Poland for an less European-friendly government for 4 years. But Poland has been the fastest growing market, or in the top 3 of fastest growing markets in Europe in that period. So unless governments start to run fiscal irresponsible policies, we don't see it impact the overall demand, and we haven't seen a change from our tenants in Romania in terms of behavior. We'll see what the elections will result in, but overall, consumers will keep spending, and that's the most important, of course. That drives a lot of the demand. As you know, we have quite a bit of retailers in Romania, 3PLs. It's driven by the local consumption, etc. That is ultimately driving demand. So we don't expect, and we don't foresee at this stage it to have any impact on our business. And then I'll let Raymond comment on the Q2 leasing.
Yeah, thank you. Well, yeah, Q2 leasing is positive so far. Yeah, and we will soon report on that officially, but so far it looks even better than Q1. And with regards to what Maarten said about all the the things happening, maybe a bit more unstable nowadays, and not necessarily just 2025, but also what we have seen in the past years. This is also supports the idea of leasing property, renting property instead of maybe owning. So leasing gives more flexibility. We can do 10-year leases. We can do break at year 5. I think that is that is not necessarily bad for our industry. For some businesses, they would maybe rather go for lease compared to ownership. So yeah, it doesn't have to be bad necessarily. And also, yeah, if it's a bit bumpy here and there, if you have what you just referred to, different governments and whatnot, that maybe we keeps away investors. We don't have an exit model. It's not like we need to build something and rent it and then sell it on to some investor. So maybe that also gives us an opportunity to compare to our peers, as we develop to hold, as you know, in line with the business park concept. Building parks for different companies and bringing amenities and utilities and facilities for companies to continue to grow their business. So these things don't have to necessarily be bad for us, for CTP as one of the players. With regards to Romania, you know that we are big fans and we like Romania. We like to invest and do business in Romania. And we like that because our clients like it. Otherwise, we would not continue to develop our portfolio. Romania turned into a regional, especially Bucharest, regional distribution logistics center kind of location. And because of all the infrastructure which has been developed, because of the consumer spending has increased so much that our clients now choose Bucharest for the regional logistics and distribution. I refer to fashion retailers, but also other companies, pet food producers, what you not, and Pepco, those kind of companies, IKEA, LPP, etc. They pick Bucharest as a hub for their regional distribution. So what they do, they get supply in from Asia sometimes, through the Constanța harbor. If it's fashion retailers, then it comes to their distribution center in Bucharest, and then from there they serve the Bucharest market, 3 million people, the Romanian market, 20 million people. But out of Bucharest, they can also do the region, and the region often includes the Balkan area, but also Bulgaria, Greece, and sometimes even to Istanbul, which is only 450 kilometers away from Bucharest. And nowadays, all of this road network has been perfectly well developed. So Bucharest is turned into a very interesting location and for regional logistics and distribution. So far, quite positive, and we see good take up and positive about the future. Outlook is good.
Our next question comes from John Bruant from Kempen. Your line is open. Please go ahead.
Hi, good morning. Thank you for taking my questions. You mentioned that you're seeing investment opportunities from churn in PE funds. Would it be fair to assume that these will be more the value add type of assets, given your return requirements on the pipeline?
Hey, John. Yes, that's correct. Similar, of course, to what we did in Germany, when we entered Deutsche Industry. We of course have higher return requirements than maybe pension fund insurance money. We can have relatively dry, stable assets. We always look to add value. Where can we add with our in-house teams, drive the operations, whether it's through regearing the lease, whether it's through refurbishment, whether it's through extensions of the building. So always more on the value add side. is more interesting for us, given our cost of capital and our ability, of course, to add value to those properties. So we are looking at that across markets in Europe. We might do here and there some core stuff, but it will be more skewed indeed to the value add. That's more our sweet spot.
Okay, clear. And then just a follow-up on Romania. Have you changed anything in your approach to Romania, or perhaps differently, how are you preparing for a potential change in leadership?
No, business as usual. So what we do is we have a portfolio of 3.3 or 3 point something million square meter, and focus is on keeping occupancy high. And we will continue to develop land and to build buildings subject to demand. But for the moment, as I said, we see strong and good demand. Yeah, so we'll be cautious and careful, but and we'll adjust to the circumstances immediately. As you know, we're very reactive and close to the. We think that people will continue to eat and buy T-shirts, but we will be careful.
Okay, fair. Thank you. That's it from my side.
As a reminder, to ask a question, please press star followed by 1 on your telephone keypad. If joining us on the webcast, please use the question box with the video player. Our next question, Pierre Clouard, Jefferies. Your line is open. Please go ahead.
Thank you. Good morning. So I have several questions for you. So let's take them one by one. So this one is on the pre-letting ratio of your new delivery. So can you remind us what was the pre-letting ratio in Q4 2024 for Q1 2025 deliveries, and what is the pre-letting ratio for Q2 deliveries today?
So we always report the pre-letting for the year. So as you might remember, what we reported is 35% pre-let for the 25 deliveries as at 31st of December 24. That increased currently, as you see, which is the normal trend that we see through the year as our deliveries are skewed to the fourth quarter. And currently is 42% for the deliveries this year, despite having delivered the 95,000 square meter in Q1, 100% pre-let. So we always have that continued increase over the quarter. The Q1 deliveries were not fully pre-let as at the 31st of December. We did some leasing in the Q1 and reached the 100%. That's how we also will continue to the Q2, Q3, and Q4 deliveries, which are now 42% pre-let at this stage, and where we expect, of course, consistent with our track record to reach the 80 to 90% at delivery. And what we did in Q1 was even better than that.
Okay, so you are not seeing any decline or let's say wait and see stance between Q4 and Q1, and there is nothing to mention for Q2 deliveries.
I think that's reflected in the increase in the leasing that we saw in Q1 with the 24% increase compared to 2024. So and Raymond commented earlier on the ongoing strong leasing demand into Q2. So we're not seeing a material slowdown across the board.
Okay, that's clear. My second question on the operation. So as you mentioned, so you reached 100% pre-letting rate for the new deliveries, and you increased by 24% the lease signed in Q1 versus last year, but there is no improvement on the vacancy. So can you remind us what has been the absorption rate that you achieved in Q1? And do you expect any improvement of vacancy over the course of the year or not?
Yeah, so if you look to the retention rate in Q1, it was 87%. So around the usual 90% that we are. We saw some churn in existing tenants, but that's normal and sometimes also good. That allows us, of course, to capture the reversion. So as long as that remains around 90%, we are pretty happy, allowing us to continue to grow with existing clients, but also in some cases increase the rents if the tenants move out, allowing us to capture that reversion. So if you look to the occupancy and to break it maybe down, it's indeed 93% at group level. Two countries are a bit lower, Poland and Germany. Both have been new market entries, so part of the new market entry strategy. So in line with our plan. If you look to the core markets, like Czech, Slovakia, Romania, Hungary, we are all around the 95% or slightly above. And that's always our target. We target to be around the 95, which always ensures that we have space available for the existing tenant to grow. And that's also what Raymond, of course, referred to with our focus on our business parks, growing with those existing clients in those existing locations. So if you look to Poland, we are currently in the high 80s, 86, 87%. By the end of the year, we expect to be more around 90. So we continue to see a good take-up in Poland, both in terms of the leasing that we have signed and the expected deliveries we plan to do this year. The second largest market in terms of the amount of space we have under construction. The second market where we are below, as indicated, is Germany. And there also Raymond referred to the split between Deutsche Industrie on one hand and the new developments on the other hand. So in the Deutsche Industrie portfolio, we are going through it on a lease-by-lease basis, do some refurbishments here and there. But that will take some time for it to increase the occupancy. But as well with the new stuff coming online, that will, of course, have a positive impact because we have advanced leasing negotiations with the assets, for example, that we plan to develop in Mulheim. We also hope to show you at our Capital Markets Day in September of this year and give you an update on that. But when those new assets are coming online, whether it's Mulheim, whether it's Krefeld, whether it's the Düsseldorf, but that's a bit longer, that's 2-3 years from now, we will expect it also to have the positive impact on the occupancy. So that's part of the normal market entry strategy, and that we are ramping up also in those markets to the 95% target that we have across the group.
Okay. On the ICR, there's a slight deterioration in Q1. So where do you think the trough will be reached, and where it could land? Is it in 2025 and two times, or how do you see it?
No, I think we bottom out around here. If you look, and we showed you in the Capital Markets Day last year that every euro we invest in the developments is extremely cash flow accretive and increases and improves the ICR, but also decreases the net debt to EBITDA. So and if you look at our funding mix, we already took a lot of the or most of the repricing risk in our funding. So we expect the ICR to bottom around 2.5, 2.6.
Okay, that's clear. And my final question on asset valuation. So you've been mentioning that you are expecting yield compression to occur in 2025. Can you give us maybe more colors on the magnitude of the yield compression that you expect, and if there is a huge discrepancies among countries?
Look, I think if you look at the transactional evidence in the investment market, has certainly picked up a lot in the last 6 to 9 months. There are material transactions in the largest markets in Western Europe taking place significantly below 5 towards 4 headline market caps. So there's room for some meaningful yield compression. At the same time, we would continue to expect the gap between Central European yields and Western European yields to narrow over time. So we think that there's a nice potential for valuation uplift in the portfolio.
Yeah, and also, of course, in the Central and Eastern European markets, we have seen in Q4 of last year, in the end of Q4, you saw Blackstone buying in Czech and Slovakia. One of our other peers bought an asset in the Czech Republic, also at yields below where prime yields are quoted. So also in the CE markets, you see more transactional activity. In Poland, there are some portfolios on the market. So overall investment markets, of course, with a bit more clarity on where cost of funding will be, are getting better, and that's driving that yield compression where Richard was referring to. And just to be clear, we don't have it in our financial models, but we like to run a conservative profile in terms of financial metrics. But based on our conversations that we are having, we expect it to see trickling through 25. As you might remember, we saw 8 basis points in the second half of last year. Might be something of a similar quantum or a bit more in the first half of this year.
Okay, that's super clear. Thank you.
Our next question comes from the webcast from Jonathan Calnater from Goldman Sachs. He's asking, why is vacancy stuck at 93% given good demand? Is it located in older or newer buildings or in specific countries, for example, Germany?
Yeah, Jonathan, I think we answered that question already. It's driven by 2 countries, but it also comes back to the business model that we are having. We will never target an 100% occupancy across our portfolio because that would limit our ability to grow with our existing clients. And especially that ability to grow with existing clients is very valuable for us because it's de-risked basically our pipeline, a natural stream of new leasing coming in. It also allows us typically to do a better return because ultimately when you attract a new client, you typically have to pay more incentives than when you are expanding with an existing client. So that business model is core to us. So that's why if we would get much over 95% occupancy, we would start building more to always have that space available for our existing clients to grow. So that has been our strategy for the past 25 years, and we continue to do that, which has allowed us to build up the market-leading position, but also the very long-term client relationships that we are having. And many of our clients, as you know, across multiple markets, across multiple of our parks, especially on the manufacturing side, we have manufacturing clients which are already in their 5th or the 6th expansion with us in the last 1 or 2 decades. And that's ultimately why we are running this occupancy, to have that flexibility, to continue to facilitate them and to continue to be that long-term partner for our clients.
We currently have no further questions, so I'd like to hand back to the management team for some closing remarks.
Then we'd like to thank everyone for your attention, and we look forward to continuing the dialogue going forward. Thanks very much, everyone. Have a good day.